You know, we spend a lot of time analyzing the shiny side of digital assets.
Oh yeah, the fun stuff.
Right, the tokenomics, the yield curves, the up-only charts that everyone loves to post.
Until they don't.
Exactly. But if you've been in this space for more than a single market cycle, you know that the real story isn't the asset itself. It's the infrastructure keeping it from just, well, evaporating.
That is the hard truth. I mean, everyone wants to talk about the penthouse view, but nobody really wants to talk about the structural engineering until the building starts to lean.
Yeah, and today we're looking at a very specific type of structural engineering. We're doing a deep dive into a risk management framework for digital securities.
And it's a fascinating one.
It really is. But here's the twist. The source material for this framework comes from Fahad Siddiqui, who is a major voice in blockchain and Islamic fintech.
Right, and before anyone tunes out because they think, oh, this is some niche religious discussion, it's really not.
Not at all.
Siddiqui has essentially drafted a blueprint for extreme risk mitigation. So whether you care about Sharia compliance or not, the mechanics here are just fascinating because they force a level of discipline that the broader DeFi market frankly lacks right now.
That was my exact takeaway, too. We're looking at a framework for investment tokens or digital securities. And the core argument here is that by applying these strict governance rules, which just happen to be Islamic principles, you actually solve some of the biggest secular headaches in crypto.
Yeah, things like fraud, rug pulls, vaporware.
Exactly. It creates this fascinating control group, doesn't it? Like,
Well,
we have the wild west of permissionless DeFi on one hand.
the absolute Wild West.
Right. And then we have this framework, which is trying to build a fortress of compliance without killing the innovation. Siddiqui's work really focuses on balancing that tension.
It does. And it's a tightrope walk.
So let's get into the architecture of this fortress. Siddiqui lays out what looks like a multi-layered defense system, and the first layer is what he calls the dual pillars of compliance.
Right. And this is where most projects fail immediately, to be honest. You have legal compliance and Sharia compliance.
Hmm.
And they aren't parallel tracks. In this framework, they are completely interwoven.
So on the legal side, he lists the standard acronyms, AML and KYC, anti-money laundering, and know your customer.
The class.
The classics. But let's be real, in the world of decentralized ledgers, implementing know your customer is a massive technical friction point.
It is, and Siddiqui fully acknowledges that, but he classifies it as a non-negotiable. I mean, if you are dealing with securities tokenized, real estate, equity, debt, you cannot hide behind anonymity.
You just can't.
No. The framework explicitly states you need to engage legal consultants to navigate the local securities regulations.
Which, sounds expensive.
Oh, it is expensive.
Yeah.
But think about the alternative. We've seen countless projects issue a quote-unquote governance token that the SEC later decides is actually an unregistered security.
And then the project gets fined into oblivion.
Exactly. This framework basically says spending money on legal consultants isn't overhead. It's survival.
Fair enough. It's the cost of doing business if you don't want a subpoena. But the second pillar is where the nuance really kicks in. Sharia compliance.
Yeah, this is the interesting part.
Right, because usually when we hear compliance in crypto, we just think of government red tape. But Siddiqui frames Sharia compliance as an actual risk management tool.
That's the key insight here. Like, forget the theology for a second and just look at the function. Sharia compliance, in this context, acts as a rigorous operational audit. It forces transparency because the underlying principles strictly forbid uncertainty, what's known as gharar, and they forbid exploitation.
So it's basically an ethics audit on steroids.
Exactly. You
Yeah.
can't just self-certify and put a badge on your website. The framework requires engaging a Sharia board. And this isn't just a rubber stamp at the very end of the process. They have a 6-point checklist that acts as a gatekeeper for the entire project.
Yeah, I looked at that checklist and it's surprisingly granular. It's not just, is this business moral? It gets deep into the weeds.
It really does. Let's look at the first point, which is underlying structure. The board has to verify what the digital asset actually represents. Is it real? Is it tangible?
So no meme coins based on vibes.
Zero vibes.
Yeah.
If the token represents a share in a property, the board needs to literally see the deed. This immediately eliminates the vaporware risk that plagues so many ICOs.
That makes sense. And then there's the documentation review. So agreements, contracts, manuals.
This one is critical. They are looking for hidden clauses.
Mm.
In traditional finance, and certainly in crypto, you often find predatory terms buried in the fine print.
Oh, all the time.
Variable rates that suddenly skyrocket or liquidation clauses that are just totally unfair. The Shariah board reviews all of these for equity. If a contract creates an unfair advantage for the issuer over the investor, it gets rejected.
Wow. So they're effectively acting as a consumer protection agency.
In a way, yes. And then point 4 on the checklist is account entries and their treatment. They want to see exactly how the money moves. It has to be transparent.
Right. And then point 5 is the fees structure. This one stood out to me because fee opacity is such a huge issue in crypto.
Oh, it's massive.
You buy a token, and suddenly you're hit with slippage, gas fees, management fees, exit fees. You don't even know what you're paying.
Right. And under this framework, that uncertainty, the GRR, is completely unacceptable. The fees must be clear, they must be fixed, or based on a transparent percentage. You cannot have ambiguous costs that surprise the investor later.
But the one that really surprised me was point 6. The board actually reviews the platform, or DApp, like the actual software interface.
Yeah, this is where it gets really modern. They are looking at the operationalization of the asset. You could have a totally compliant asset, but if the user interface uses dark patterns.
You mean those design tricks that manipulate you?
Exactly. The tricks that nudge you into trading more often or taking higher risks. If the app does that, the whole thing could be deemed non-compliant.
That's a heavy lift, though. You're asking scholars to audit UX design.
It is a heavy lift. But think about it. It addresses a massive risk vector, which is behavioral manipulation. If the app feels like a casino, it violates the principle of avoiding gambling. So the interface itself basically has to be boring. It has to be highly functional and honest.
Make crypto boring again. I kind of like it.
It's a solid slogan.
So you have this rigorous audit of the legal side and the ethical structure, but then you have the external environment. The framework talks a lot about regulatory engagement.
Right. This is the strategy of proactive communication.
Which is the exact opposite of the move fast and break things ethos we're used to.
Completely the opposite. The framework suggests you shouldn't wait for the regulations to come to you. You should be talking to the local authorities and participating in industry consultations long before you launch.
I can hear the crypto purists screaming already. They'll say, asking for permission stifles innovation.
And sure, it might slow down the speed of deployment, but does it stifle the quality of innovation? Siddiqui would argue that building a product that just gets banned in 6 months isn't innovation, it's a waste of capital.
Right.
By engaging early, you are essentially stress testing your business model against the law.
Okay, let's pivot to the technical side. Part 2 of this deep dive is technical fortification. Because you can have the best lawyers and the most pious scholars, but if your smart contract has a reentrancy bug, the money is gone.
Gone in seconds.
Yeah.
And there is no Sharia board on Earth that can reverse a blockchain transaction.
Exactly. So the source doubles down on smart contract audits. But honestly, every project claims they are audited. What is actually different here?
It's the scope of the audit. Standard audits usually just look for security vulnerabilities, like can a hacker drain the wallet?
Right.
But this framework implies a much broader scope. The audit needs to verify that the code actually executes the Sharia and legal requirements we just discussed.
Oh, that's a really good distinction. So if the legal terms say fees are capped at 2%, the code audit needs to verify that the smart contract physically cannot charge 2.1%.
Precisely. It's verifying that code is law, actually matches the actual law. But this brings up a massive tension in this framework. What happens if a vulnerability is found after launch? Or what if the Sharia board decides an asset is no longer compliant?
Right, because in a truly decentralized system, you're stuck. You can't just turn it off.
Which is why this framework leans so heavily on stack security and strict custody measures. It basically suggests that for these types of assets, digital securities, you likely can't have total decentralization.
Oh.
You need robust custody solutions, potentially even institutional-grade cold storage to protect the assets from being compromised.
So we're moving away from the whole not your keys, not your coins mantra toward trusted custodians with massive insurance policies.
For institutional adoption, yes.
Uh-huh.
The framework recognizes that the average investor cannot be their own bank security manager. It's just way too high risk.
Yeah. Which brings us nicely to the human element. Part 3. The investors.
The most volatile variable in the entire equation.
Right. Siddiqui lists investor education as a core pillar. And I feel like this is often just lip service in the industry, like read the white paper, do your own research. But nobody does.
Nobody does. And that DYR, do your own research mentality is actually a massive failure of risk management. You cannot blame the user for not understanding complex cryptography. The framework puts the onus strictly on the issuer.
So what does that look like practically?
It means regulatory-geared risk disclosures. It's not enough to just have a generic disclaimer at the bottom of the website. You have to actively educate the investor on market volatility, liquidity risks, and specifically, how to spot scams.
It connects right back to that transparency requirement. If you are hiding the risks, you aren't just being shady. Under this framework, you are technically non-compliant with the ethical standard.
Exactly. And to back that up, the framework calls for actual investor protection mechanisms, things like formal dispute resolution processes.
Which is fascinating. If I have a dispute with a DAO right now, usually my only recourse is to complain on their Discord server.
Right, and then you just get banned by a mod.
Exactly.
This framework demands a formal process. It also heavily emphasizes the use of escrow services.
Escrow is such an old school concept, but it works.
It works because it bridges the trust gap. If I'm buying a tokenized asset from you, a third party holds the funds until the asset is fully verified. It removes the counterparty risk entirely.
Now, I want to drill down on due diligence here, because the source notes that this isn't just about the token. It's about the underlying asset.
Yes, this is the real-world asset problem, the RWA problem. If you tokenize a hotel in Dubai, the digital token is basically just a receipt.
Right.
The risk isn't in the blockchain. The risk is that the hotel burns down, or the developer goes bankrupt.
Or the hotel never existed in the first place.
Right. So the due diligence requirement here mandates assessing the quality, value, and legal status of the physical asset. You need appraisers, you need inspectors, and legal checks on the property itself, long before you write a single line of code.
It seems like this framework is trying to solve the liquidity problem too, which brings us to part 4, market mechanics.
Liquidity is the silent killer of tokenized assets. You might own $10,000 worth of a tokenized painting, but if there is no secondary market for it, you effectively have $0.
You're just locked in.
Completely. Siddiqui's framework emphasizes that you cannot launch these assets in a vacuum. You need to partner with established exchanges or create secondary markets to ensure proper price discovery.
And this is where the source mentions Mabrook. It's listed as an entity committed to these standards, specifically regarding valuation reporting.
Yes, and that is a really key reference. Mabrook appears to be positioning itself as a platform that doesn't just list tokens, but actively enforces this valuation standard. They are trying to solve the problem of what is this thing actually worth right now?
Because in crypto, usually the market decides the price just based on height.
Pure height.
But for a security token, the price should be based on the asset's actual performance.
Exactly. If the token represents equity in a company, the price should reflect that company's earnings, not just how many people are tweeting about it today. Mabrook's role, seemingly, is to provide that rigorous reporting so investors aren't just flying blind.
This brings up the broader ecosystem, because you can't do this alone. The framework talks a lot about system integration and collaboration.
This is the real so what for the industry. Siddiqui argues that fintech innovators need to stop fighting the establishment and actually start collaborating with standard-setting bodies. He specifically mentions AAOIFI and the IFSB.
Let's unpack those acronyms for you listening. AAOIFI is the Accounting and Auditing Organization for Islamic Financial Institutions.
Think of them as the GAP, or the FASB of the Islamic finance world. They set the gold standard for how these transactions should be recorded and structured.
And the IFSB is the Islamic Financial Services Board.
Right, which focuses more on stability and solvency standards. The core argument here is that the digital asset issuers need to adopt AAOIFI standards.
Why is that so important, though?
Standardization. Right now, every single token project invents its own accounting rules. It's a complete mess. If we can get digital assets to adhere to AAOIFI standards, suddenly they become interoperable with the massive global Islamic banking system.
Wow.
We were talking about trillions of dollars of capital that could enter the space.
But that integration is hard. Traditional banks, Islamic or otherwise, are terrified of crypto risks.
Which is exactly why this framework is so heavy on risk management. It's essentially saying to the banks, look, we have done the AML, we have the legal sign-off, we have the Shariah audit, we have the technical audit, and we are using your accounting standards. It is safe to come in.
It's building a bridge,
Yeah.
but it's a bridge made of a lot of paperwork.
It is. But that paperwork is what turns a speculative gamble into a truly investable asset class.
So let's zoom out for a second. We have a framework that is arguably more rigorous than what we see in the standard stock market, let alone the crypto market.
I would argue yes. By layering the ethical and Shariah requirements on top of the legal requirements, you eliminate a lot of the gray area behavior that Wall Street often gets away with.
It forces a discipline that is really rare, but I have to play devil's advocate here.
Go for it.
doesn't this much friction kill the primary value proposition of crypto? Like the whole point was efficiency, speed, removing the middlemen. If I have to pay lawyers, scholars, auditors, custodians, and escrow agents, am I just recreating the traditional banking system on a slower database?
That is the trillion-dollar question. And frankly, if your goal is day trading meme coins, then yes, this framework is complete overkill. But remember, the topic is asset tokenization, digital securities.
Right. We aren't trading Dogecoin here. We are trading buildings and equity.
Exactly. For those real-world assets, the friction is already there. Real estate deals take months. IPOs take years. This framework doesn't necessarily make it slower than the traditional process, but it makes it safer and way more transparent than the current crypto process.
So it's not about beating the speed of a centralized server. It's about accessing the liquidity and global reach of the blockchain, but without the risk of total collapse.
Precisely. It's about creating a safe lane for serious institutional capital.
And for you listening, whether you are in Dubai or Denver, this matters because these standards, the transparency, auditing, ethical checks, are likely what all regulations are going to look like eventually.
I completely agree. The regulators in the US and Europe are slowly converging on these exact same principles. Custody, disclosure, audits. Fahad Siddiqui's framework just happened to get there through an Islamic finance lens, but the destination is exactly the same.
It's convergent evolution.
It really is. And it leaves us with a pretty provocative thought to chew on as we wrap up.
I'm ready.
We usually think of DeFi and ethics as totally separate conversations. DeFi is about code, right? Ethics is about philosophy. But looking at this, it seems that ethical constraints, specifically the ban on uncertainty and the strict requirement for transparency, might actually be the most effective security patch we have.
Explain that a bit more.
Well, think about the biggest crypto collapses of the last few years. FTX, Luna, Celsius.
Massive, massive failures.
But were they failures of code? Mostly, no. The code did exactly what it was told to do. They were failures of transparency, hidden leverage, and misuse of customer funds.
Human failures.
Exactly. They violated every single point on that Shariah checklist. Hidden fees, gambling with user funds, total lack of segregation. So the provocative thought is this: could these ethical frameworks, whether they are secular or religious, be the actual missing link for mass adoption?
That's a great point.
Maybe we don't need better code. Maybe we just need better values encoded into this system itself.
That is a fascinating take. We're all sitting around waiting for a software update to fix crypto, but maybe what we really need is a governance update.
I think we do.
Well, there is a lot to think about there. That is our deep dive on risk management and Islamic asset tokenization. A huge thank you to the work of Fahad Siddiqui for providing such a clear roadmap today.
Indeed. It's brilliant work.
Thanks for listening. We'll see you next time.